It is Wednesday, May the 6th, and this is The Breakdown. I'm your host, David Canellis, and we have a few stories happening around crypto, happening around the internet for you this morning. First, we're going to take a look at the Coinbase layoffs from yesterday and what's going on with that. We're also going to look at some brutal losses posted by Strategy in the first quarter of the year, which probably to be expected considering Bitcoin is not exactly pumping very hard. But interesting to note that it might even be selling Bitcoin soon, or so it might seem. We're going to have a look at that. We're also going to be looking at crypto VC funds are back. a16z has raised a bunch of money. And it's not the only one this year. So perhaps crypto is not as dead as Pomp might like to say it is. All right, this is The Breakdown. Without further ado, let's get to it. This episode is brought to you by Nexo. Step into a new era of digital wealth. Earn interest on your digital assets, borrow against them without selling, and trade all in one platform. Get started at nexo.com/breakdown.
Nothing said on The Breakdown is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are opinions, not financial advice. Hosts and guests may hold positions in the company's funds or projects discussed.
All right, up first, let's take a look at this Coinbase stuff. So the headline is that Coinbase just laid off 14% of its staff to focus on AI efficiencies and all that sort of thing. The news was broken, at least on Twitter, by Brian Armstrong in an email that he sent to all employees at Coinbase. Why now, he says, two forces are converging at the same time. We need to be front-footed to respond to both. First, the market, so market conditions. Second is AI is changing how we work. He says, over the past year, I've watched engineers use AI to ship in days what used to take a team weeks. Non-technical teams are now shipping production code, and many of our workflows are being automated. The pace of what's possible with a small focused team has changed dramatically and it's accelerating every day. I mean, it's a very long post that essentially comes down to, hey, crypto is not exactly pumping right now, and we need to streamline our workforce as the same as it did in 2022 and 2023. So it's not exactly out of the ordinary that Coinbase would have these cyclical layoffs. And the same goes for across even finance more broadly. They do it every year, even if, you know, the justification, or at least the publicly stated justification in recent times has been, hey, we're really good at using AI, so we don't need these people anyway, is essentially what a lot of these companies are saying. And whether or not that's true is dependent on how bullish you are on AI and whether or not you believe this is like AI washing. But I digress. Something interesting to note is that at least what Brian is projecting is that they're hustling. So they say that they've flattened our org structure to 5 layers max below the CEO and COO. I mean, leaders will own much more with as many as 15 plus direct reports. So, okay, they have leaders with maybe more than a dozen direct reports and also no more pure managers. So every leader at Coinbase must also be a strong and active individual contributor. Managers should be like player coaches, getting their hands dirty alongside their teams. And okay, that's perfectly fine. But something that does give me pause is what he just said about non-technical employees shipping code. Let's go back to that part. Yeah, non-technical teams are now shipping production code, which, okay, if it's like a copy update on the app or like a new button that does something, then okay, then I mean, I'm not really interested in that stuff. But if there is non-technical teams shipping code for one, the America's biggest crypto exchange, then that makes me worry a little bit. And I'm hopefully that perhaps Brian Armstrong is, I don't want to say stretching the truth, but embellishing the reality that actually you do have a backstop, a human senior software engineer backstop that is making sure that the Claude output of that code is up to scratch. But I mean, we already have examples of let's go back to this Amazon story. So let's just quickly jump to this, and I know this is not directly relevant to Coinbase, but perhaps it's a cautionary tale. Amazon's AI code broke production. Don't let yours be next. This is a story from March, when an AI-assisted code change triggered 1.6 million website errors and 120,000 lost orders. 3 days later, a separate incident caused a 99% drop in orders across North American marketplaces. Amazon called it high blast radius. Engineers speak for everything is on fire. So, like, I just hate to. I mean, we know how interconnected the crypto space is, and we know how much like the forefront of some price discovery happens exactly on Coinbase, and not to mention like ETF functions, all that kind of stuff. And if we have non-technical teams shipping code that is related to that stuff, then I would inherently worry about that, and I would expect that we are going to see some kind of snafu over the next year. If not at Coinbase, then at another smaller crypto exchange that might be reading Brian Armstrong's tweet about how AI forward they are and how efficient they're being because of AI, and then perhaps that exchange. Perhaps it will be another smaller exchange that something will happen. But I would expect that we're going to have some kind of avoidable snafu just because of this relentless energy around founders and C-suites not wanting to miss out on efficiency gains from generative coding. But perhaps I'm just being a little bit too bearish on the whole thing, and actually AI is smarter than everyone else. But hey, what can you do? So, I mean, reading into this, I'm inclined to just say, well, look, layoffs happen all the time. If it wasn't AI that wasn't going to be the reason, then it was just going to be straight up market conditions, or it was going to be some other org change or shift in strategy, or just the need to cull the middle managers so you can have fresh eyes on a lot of these products that they're shipping out and all that kind of thing. So yeah, the most interesting thing here is that Coinbase is apparently shipping code with non-technical teams reviewing it, at least going by what Brian Armstrong is saying, which I don't know. Perhaps we don't really need that level of AI adoption right now. But no worries. Step into a new era of digital wealth with Nexo, the premier digital assets wealth platform. Earn interest on your digital assets, borrow against them without selling, trade a wide range of cryptocurrencies, all in one place. Nexo is now available again in the US with an evolved product suite tailored to today's market. For a limited time, new US clients can unlock 30 days of exclusive Wealth Club Premier benefits, including enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Get started today at nexo.com/breakdown. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Yeah, hopefully everyone from Coinbase who was affected by those layoffs lands on their feet. But I'm sure that there's plenty of teams out there that are looking to snap those people up. Something else I wanted to point out related to that is that we have this tweet here from a couple of weeks ago, April 22, from the head of platform at Coinbase, Rob Witoff, I want to say. In the last 12 months, we've seen a 27x increase in non-engineers using dev tools like Claude, OpenCode, and Cursor to build and automate how we work. The goal is to turn everyone into a builder and safely, he has that bolded and italicized, reduce the distance between idea to execution to near zero. Trust is our most important asset in Coinbase, so this is fueled by a massive effort in quality guardrails and simplification. Without much more exposition about what those guardrails and quality controls are. So I just think it's quite interesting that we're seeing this tweet come 2 weeks before we have layoffs, and then Armstrong positioning the company as a very AI-centric hub for code production and shipping as quickly as possible. So yeah, I mean, maybe that will give you a little bit more context about what the atmosphere is like at Coinbase, which, I mean, crypto is just incredibly interesting because it is the intersection of code and money, and it's just Coinbase's influence. I mean, what are the stats again? I'm just going to pull it up. One sec. Yeah, so here's from, I mean, this is Q3 in 2025. It's just all I could pull up really quickly. But Coinbase custodies 300 billion in user assets, which is something like 12 or 13% of crypto's entire market cap is custodied on Coinbase on the same code that non-technical people are apparently shipping code to. So, my optimistic read here is that actually it's non-critical code that non-technical Coinbase employees are shipping code to, which I have to hope that is the case. If that is the case, then it's much less impressive to me that there's these like minor fixes and minor bugs on stuff that doesn't actually handle the crypto that is being managed by AI, which, okay, that's cool. I mean, it could have been any other software that could have helped those people manage that code as well. So, I mean, okay, so it's just a little bit more context there about the scale of the production code that Coinbase is working with. Okay, what do we have next? All right, we have a new fundraise here from a16z Crypto, Fund 5, and this is a blog post from Chris Dixon and the other people involved in running the fund. It says crypto cycles tend to follow a pattern. A wave of speculation pulls in attention and capital. Some of it gets wasted. Some of it funds infrastructure that wouldn't otherwise get built. When the noise dies down, what's left is usually more useful than it looked at the peak and more durable than it looked at the trough. Okay, we have a16z Crypto's Fund 5, which has raised $2.2 billion to inject into what seems to be a new wave of infra investing. So they say that this is why we're announcing our new Fund 5. It is built for this moment. And then we have a link here. What does the link say? They link to a Chris Dixon blog post from February that says it's the long game for crypto, which is essentially making out that the policies like the Genius and Stable Act that are working their way through Congress will eventually lead to an explosion in payments and stable coins and DeFi and all that kind of stuff. So the founders we're backing with this $2.2 billion fund are working on the part of the cycle that gets less attention and we believe produces more of the lasting value, turning new infrastructure into products people use every day. That is how every important computing platform has eventually mattered, and it is how crypto will too. So it looks to be a repackaging of the infrastructure meta. I am hoping that does not mean we are going to see a bunch of more alternate layer ones and more layer twos for Ethereum, and instead that infrastructure, I suppose, has to do with agent to agent payments and all that kind of stuff. And they do have some of that in here. These properties are showing up in real products, in payments, in financial services, in creator platforms, in decentralized infrastructure, in new ways for people and machines to coordinate. In practice, this means sending money globally in an instant, holding dollars without relying on a bank, tokenizing assets so they can move frictionlessly anywhere, tapping into composable networks that others can build on, and embedding these capabilities in applications everywhere. So, okay. I mean, for one, we can already send money globally in an instant. We have on-chain rails and we have stablecoins. We can't hold dollars per se without relying on a bank because you're just using stablecoins as those dollars because we don't have CBDCs or whatever. But I suppose we can already do that. Tokenizing assets so they can move frictionlessly anywhere. That's happening, so that's cool. Tapping into composable networks that others can build on. I mean, okay, that's cool too. And embedding these capabilities in applications everywhere. So I'm not too sure what is new coming out of this fund, but I suppose that's okay. It is just a maturing of the strategies involved in building up these infra businesses, specifically for the AI agent economy, which is still getting off the ground. But I just want to say that I love the fact that the machine to machine payment stuff is coming back around, and I know we're used to it by now, but I mean, does anybody remember IOTA? Does anyone remember the Internet of Things that in 2016, 2017 I mean, IOTA was the big one. IOTA was in the top 5 coins or something like that because they were obsessed with this idea that smart fridges had to pay other smart fridges or something like that in order to balance the amount of butter that are in the fridge, or whatever it is. And that didn't really go anywhere. I mean, I know that it was that stable coins weren't really a thing, but we had this already. And then it's like nearly 10 years later, we're coming back around to wait, machines can actually use crypto and everyone has to pay for APIs and whatever. So I guess that makes a degree of sense. But what's also really cool is that it's not just a16z that is raising money. There's also Horn Ventures. Let's pull that up. Let's take a moment to talk about Nexo. Nexo delivers a premier digital assets wealth platform designed to help clients build, manage, and preserve their wealth, earn interest on your digital assets, access crypto-backed credit without selling your holdings, trade with advanced tools, all supported by 24/7 client care. Now back in the US, Nexo offers new clients 30 days of exclusive Wealth Club Premier access. That means enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Benefits typically reserved for Wealth Club members and private clients. Nexo is also expanding its global presence, becoming the official crypto partner of Tennis Australia, the organisation behind the Australian Open, and the digital asset partner of the Audi Revolut Formula One team. If you're ready to approach digital assets with a more structured wealth strategy, visit nexo.com/breakdown to get started.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
Yeah, so here is Horn Ventures, and this is, for those unfamiliar, Katie Horn used to be at a16z, and this is only on May 4th, so only 2 days ago. She announced that her firm had raised $1 billion to inject into the crypto space. And let's see what she had to say in terms of what the focus is going to be. 3 areas that we're following closely: the new financial infrastructure, the core plumbing of global finance, payments, banking, capital markets, custody, foreign exchange is being rebuilt for a world that is digital, global, and always on. Building the next generation of financial services from scratch includes crypto, but it is bigger than that tool set alone, and in general will mean using better technology, fewer intermediaries, and no legacy constraints. Okay. The second one is new assets and markets. So tokenization is kind of the thing, and a lot of the derivatives associated with those tokenizations, which that does make sense considering the rise of hyperliquid and prediction markets, and then the agentic economy. So, and I'm not the first one to point this out. Here's a tweet that I came across here on that 6 billion plus in fresh crypto VC funding closing or raising right now. And I think that these are numbers for all of 2026 to date. So Dragonfly raised 650 million at the start of the year, Parify Capital 125 million, Horn Ventures, there's the 1 billion, a16z's 2.2 billion, BCAP, which is blockchain capital, apparently they're raising 700 million. Paradigm is supposedly rumored to raise 1.5 billion for AI and robotics. So perhaps not directly related to crypto, but that is just rumored for now. The thesis is the same across the board: stables, RWAs, AI agents transacting on-chain 24/7. VC money is chasing the infra to bring IRL finance and autonomous economies on-chain at bare valuations. Infra supercycle. Very optimistic read there. And yeah, I mean, if all of the crypto space is relying on this idea that there is going to be billions of AI agents needing to make micropayments on ultra cheap chains for AI calls, and buying data per use or compute per use, you know, I'm not too sure that it is really going to have the desired effect that people are expecting. We know that on-chain rails cannot handle that amount of activity at all. I mean, if we had 5 billion people on-chain transacting every day, making micropayments on Ethereum or even an L2 or on Solana, I would expect that there would be a lot of congestion and fees would be incredibly high, and it would remove the impetus for AI agents to use on-chain rails at all, because it would just be too expensive. At that point, it would be cheaper to use a credit card, or it'd be cheaper to use Swift or anything. It might even be cheaper to just mail in payments, or dare I say it, go back to the subscription model that we are trying to escape. So if the infrastructure for AI agents is more high throughput chains and stuff like that, then I don't know if we're ever going to break through that bottleneck. At least in the next couple of years, we're going to need some kind of advancement with quantum computing in order to boost the throughput significantly. Again, I'm beating my head against a logical wall when it comes to what we are meant to expect from more investment in infrastructure. If the idea is to micro payment max for AI agents. I'm just hoping that we can all have some kind of realism here about what it entails. But hey, I'm not the one raising the money and I'm not the one spending the money. So please, if I am just not bullish enough on this whole thing and you have a thesis on how more investing in infra is meant, like specifically on-chain infra, if it's off-chain infra, then that makes a lot of sense. And if there's some way that you can have finality on-chain payments for the agentic commerce sector that is a combination of off-chain and on-chain, and then we can really have the throughput needed to serve everyone's autonomous AI agents that are shipping code and micro-transacting for data, then hey, then maybe that might make a lot of sense, and maybe that's where all this is headed. But hey, if I'm missing something, as always, just yell at me on Twitter and tell me that I'm wrong. But in the meantime, let's jump over to the Blockworks research platform because we have a cool funding and M&A analytics tab. So let's have a look. And it does seem that this is updated with at least the a16z's stuff. Yeah, we've got the Horn Ventures stuff in here too. So let's have a look at the chart for total crypto deal activity. Let's blow this up a little bit. And we can see, I mean, May, it's only the 6th of May. So we're not even a full week into May. And this column here on the right, on the far right, is pumping, considering we've only had a week of May. So we're up about a third on April already, and we're heading towards about a third away from March. So if this trend continues, if there are more fundraisers confirmed, we could be heading into May being the best month for 2026 so far. But of course, it's really far below what was happening in mid 2025 and late 2025, when in October, the total M&A count was almost 20 billion. And right now in May 2026, we're at about 7.6 billion. So still some ways to go, but it's not like crypto VC is dead at all. But hey, if that can be the fuel that lights the fire for a bull market in 2027 or late 2027, fueled by the seeds of these massive fundraisers, then hey, there's no way that you could be upset with that. But okay. All right, what have we got next? All right, and yeah, I mean, it's bearish if you believe that strategy is inherent to the valuation of Bitcoin, which it definitely has influence on the price of Bitcoin, at least on the way up. But strategy has posted some pretty brutal losses for the first quarter of this year. Let's have a look. This is from CNBC. Yeah, strategy posted a $12.5 billion net loss in the first quarter due to the slump in the Bitcoin price during the beginning of the year. This is from Phong Lei, CEO of Strategy. He says, our ability to sell Bitcoin either to buy US dollars or sell Bitcoin to buy debt, if it's accretive to Bitcoin per share, is something that we would consider doing going forward. And I mean, they've flagged some similar stuff before. I mean, I know that strategy that Saylor really likes to bull post himself, never selling or will buy the top forever, Laura, that kind of stuff. But at least seems to be the strongest implication that might become a reality if Bitcoin's price continues to at least go sideways and even down a little bit. We will sell Bitcoin when it's advantageous to the company, he said during the earnings call. We're not going to sit back and just say, we'll never sell the Bitcoin. We want to be net aggregators of Bitcoin, increasing our total Bitcoin, but more importantly, increasing our Bitcoin per share, because we think that is what's going to be the most accretive long-term for MSTR. Which, I mean, it's brutal to see strategy say this stuff. I believe right now their cost basis is 75.5K per coin. So at 80K, we're a little bit ahead, but that is being extremely optimistic that we aren't headed for more downside in the near future. So Saylor actually said this on the earnings call as well. He compared strategy to a real estate development company. You know, the Bitcoin is digital real estate kind of thing. If you bought land for 10K an acre and you sold it at 100K an acre, and then you bought more land with profit, or if you sold at 100K an acre to pay some interest expense on debt that you used to buy more land, nobody would say that's bad for the price of real estate, and no one would say that proves the business doesn't work. Real estate development companies literally exist to buy land cheap and sell it expensively, he added. We're like a Bitcoin development company. And okay, I mean, that is just turning strategy into a fund, isn't it? I mean, you know, perhaps my layman's brain is misinterpreting that, but he's essentially saying, hey, sometimes we'll buy Bitcoin low and sell it high, and then other times we'll hold it until maybe we need to sell it. This is just a fund to me. But all right. So let's just have a look at the latest on MSTR as a digital asset company. One's as a digital asset treasury company. So here we have on the Blockwest research platform, we have this Bitcoin treasury companies chart, which is by BTC per share, which Saylor says is or at least strategy says is the most important metric apart from how much Bitcoin they actually hold. We can see that there is for strategy there's 189 Bitcoin per share, which is far and above number 2 here, which is CPO. CPO is actually Adam Back's Bitcoin treasury firm that was Cantor Equity Partners before, and MicroStrategy's Bitcoin per share is going in the right direction. At least it has been higher than it is, but since basically February, it's been trending upwards. But of course, the main thing that everyone is wondering is if strategy it buys so much Bitcoin and the price of Bitcoin goes up as strategy accumulates, then what's going to happen to the price of Bitcoin when they start offloading it? And to that, I tend to be a little bit optimistic in that if strategy has indeed overextended itself in terms of what it can do to accumulate Bitcoin, then there should be other firms that haven't overextended themselves and can just buy Saylor's coins. Let's take a look at how the ETFs are doing, because this relationship between DATs and ETFs has always been somewhat fascinating, because they sometimes they tend to operate in different directions. So, okay, let's just pull up the crypto ETFs tab on the Blockwest research platform to see if we can have any insight into what's happening on the other side of the DAT coin, the crypto ETFs. So let's have a look on the daily. We are looking at quite a big spike in inflows on May 4, which is really good for the ETFs, because there's a few days of outflows and then a big spike of inflows. In general, it looks like we are headed towards a little bit more accumulation from the ETFs, at least compared to what was happening in February. So there could be the case that, if strategy has to sell, then there might be other market participants that are interested in buying. And we do see that somewhat reflected also just within the DAT companies. There's news here that one, it's not just there's not just strategy that might be selling Bitcoin. We have recent news out yesterday that French chipmaker Sequans dumped half of its Bitcoin as treasury hype meets reality. So they have mounting losses and debt obligations. So they had to reverse their strategy of Bitcoin accumulation, or at least Bitcoin holding. Okay, it's not just strategy, but then if you look a little bit closer in the headlines, there is actually a separate Bitcoin treasury company that is actually buying. So here we have the Smarter Web company tops up Bitcoin position, leading to some increases in its share price. So they added another 27 Bitcoin to its treasury, taking total holdings to about 2,800 Bitcoin. And it has a 10-year plan strategy of acquiring Bitcoin. And okay, these numbers are relatively small, especially compared to the amount the strategy is doing. But so this is what I mean, is that the more digital asset treasury companies that we have, and the more companies that are interested in accumulating Bitcoin, and just more ETFs, and all of that kind of thing, then we're going to have a diversity of strategies, financial health, and velocity around buying. So I am, I mean, for one, I'm almost certain that it's a very easy call to make that the price of Bitcoin would go down if strategy really starts selling at scale. But at the same time, there has been a massive Cambrian explosion in digital asset companies and ETFs and institutional. I mean, not just in the US, ETFs around the world. There's a lot in Europe that are accumulating Bitcoin too. So the market has expanded much to be a much healthier and diversified place than what it was when strategy started buying Bitcoin in August 2020. So whatever happens with strategy in the next 6 months to a year, it could be bad for that particular company, and it would certainly, I'm almost certain, would be bad for the price of Bitcoin within the parameters of when strategy is selling, depending on how much it needs to actually offload to satisfy its financial situation. But I am optimistic that there are just more companies out there that are taking that into consideration and would use that opportunity to buy the dip and beef up their own individual buying strategies. That's my take. But apart from that, I mean, there is a few smaller stories happening around crypto right now. Speaking of the agentic meta, Solana and Google Cloud launched a stablecoin payment service for AI agents, which sounds quite bullish to me about the agentic commerce meta. We also have Western Union launching its own stablecoin, I believe in the Philippines to start with. So yeah, more on the fintech side of crypto, and that is truly expanding. But in terms of the most interesting thing, I think we've covered that to date. I'm looking forward to checking back in on adoption of the AI agentic commerce side of crypto and whether or not these Google Cloud initiatives have moved the needle there. But perhaps we'll save that for Friday. In the meantime, look after yourselves and please smash like and subscribe. If you're watching this on YouTube, do the equivalent if you're listening to this on Spotify or Apple Podcasts. Share it, leave comments for us. I read them all. So please, if you just, I would love to hear from you. In the meantime, yeah, I said it, but I'll say it again. Look after yourselves. Goodbye.